Who's pulling the strings of the world? Every single conspiracy theory out there ultimately lands up on a banker. Almost always he's the villain. I say if you want to understand the world in which we live, you have to have an understanding of the world of finance. Economy is production. We don't just get our food and our stuff as manna from heaven. Only once we produce can we consume. There's a lot of misinformation with regards to what is really going on in the financial sector. I don't know if any of you have ever watched the movie Wall Street. The rich get rich by exploiting the poor. We therefore have to control and regulate them. People have a lot of misconceptions about how stock markets work and why they are productive. All this control stops the market from working the way it would otherwise work. We don't have a sense of how fragile the whole system is. We want to get an economy going, get a bunch of businesses started. Without finance, civilization really does collapse. And yet we're stuck in this mentality of, no, markets are very short term. There's very little of the challenging of the status quo. You're going into a meeting with a Steve Jobs, a hippie, hasn't had a shower in 3 days. What's the probability you're going to get that money back? The world is pretty complicated. There's a lot of moving parts. Great venture capitalists are really good at screening out the garbage. They make 10 investments, and one will be a home run. So, finance. It's everywhere. You just can't avoid it, right? I think I took a Uber here, maybe it was Lyft, I don't know, one of those services over here. I mean, that couldn't happen, right, without finance, without my credit card being somewhere in the company's database and a transaction happening in the background that facilitated the transfer of my money into the account of the Uber company, right? And they have a bank account and I have a bank account, finance, the credit transaction, finance. Almost everything we do touches the world of finance. You really can't avoid it in your day-to-day life, whether you use a credit card, a bank, maybe some of you remember checks. It's been a long time, right? Hopefully you all got a little bit of money put away, kind of saving. Maybe you're saving for retirement. Maybe you're saving to buy a car. Maybe you're saving to buy a house. That saving could not happen without finance. Otherwise, you'd be tucking it into the mattress and it would be a long, long time before you got that car or before you got anything. There'd be no return on that money. It would be just stuff in the mattress. You buy a house or a car, you probably take out a loan, finance. You maybe have a stock portfolio, finance, everything. There's just no transaction that we engage in the world in which we live today. There's no trade in which we really do that does not involve a financial institution, a financial market, or a financial product. It is ubiquitous in our modern world. The modern world could not exist the way it exists today without it. So we're going to talk over the next 8 classes about breaking this down, trying to understand the different components, trying to figure out what this thing is, what is finance. We're going to talk about its history, where the different products, the different institutions, the different markets have come from, how they've evolved. And in the background of all of this, we're going to talk about the fact that in spite of the fact that finance is ubiquitous, it's everywhere, that it seems like we resent it, we hate it, we don't like it, right? I mean, we'll talk about this, but when was the last movie you saw where the financier was the hero, right? Almost always he's the villain, right? Or what, novel you might have read, or any depiction in popular culture, popular press, or anywhere where finance is presented as a positive versus as a negative. So we have this thing that's ubiquitous, you have this thing that the modern world cannot survive without, and yet there is this underlying negativity about it all, right? Civilization couldn't exist without it, and yet we hate it, we despise it, and we'll talk about kind of the historical causes. So let's just start with what finance is, right? What finance does, what is involved. And, if you think about different financial markets, different financial institutions, maybe we should talk about the primary product of money. What's the primary product of money? Sorry, primary product of finance, right? I gave it away. Money. The primary product of finance is money. So we're going to be talking about money, what it is, where it comes from, what kind of money we've used in history, what kind of money we use today, what kind of money we might be using in the future. Money is a human creation, and as such, it's something that can change over time and has changed over time and might, I suspect, will change over time. So money is obviously the product of finance. But what else? We've got banks, right? We've got investment banks and commercial banks and mortgage banks, and we used to have saving and loans, and we've got insurance companies, mutual funds, hedge funds, private equity funds. God, a lot of these, right? And then you've got bond markets and money markets and stock markets and all kinds of financial institutions, all kinds of financial markets. There's a huge variety and a huge array of these things. We won't have time to talk about every single one of them, although we will in principle. We'll focus primarily on two. We'll focus primarily on banking, on really understanding banking. Banking has been historically kind of at the core of what finance is and at the core of how finance functions. We'll talk about how banks work, how they function, what are the issues with them, what is the future of banking. And then we'll spend some time on the stock market as representative of markets. And we'll mention some of the other financial institutions, financial markets along the way. But those are going to be two that we really spend some time focusing on. So what is common to all these institutions and all these markets? What is the same about all of them? What can we say is common about them all? Well, I mean, they all are there in some way to facilitate savings, right? All of us engage with financial markets because we might have excess money, we might have some excesses, and this is we'd like to save it for the future. We'd like to use it in order to plan for the future. So all these financial markets and institutions facilitate ability to save. Not only to put the money aside and to protect it, right? You can put it in the mattress. Risky, right? Somebody might come and take the mattress. Might get burned down or whatever. So one of the reasons we want to put it in some safe box or in a bank or somewhere like that is safety. But also because savings, for a variety of reasons we'll talk about, actually generate a return. We actually get something more. Call it interest. Call it profit. Depends on the form in which the saving takes. But there is a return, that is, the saving actually grows. Over time, we have more. And that's part of what financial institutions facilitate, is this ability of our savings to grow. And in that sense, in the sense of saving, we have the ability here to facilitate investment, right? All the saving goes where? The only way in which it can grow is if it's invested in something, mostly in something that is productive. Mostly in something that has generated something out there in the real world, that is actually creating real wealth, that is actually ultimately creating real returns, which generate the growth of our savings. So by aggregating all these savings, we can, as financial institutions, financial markets, we can make significant investments. Think about, any kind of startup or business that wants to expand. It requires capital. That capital is going to come from people out there who are trying to save their money and want it to be deployed for productive purposes, would like to see it grow. And what we're seeing here is really the function of financial markets and institutions is to match my desire to save with productive activity that's actually going on. Right? And the primary, of course, has to be productive activity, because that's where the return comes from. That's where the profit comes from. That's where the wealth creation comes from. And that's, of course, me producing is where I get the money that I can then save. I can't save money unless I produced it first. One of the great fallacies in economics. One of the great fallacies in economics is this idea of the primacy of the consumer. This idea is that consumption is what's really, really important. Consumption is what drives an economy. This goes back to Keynes. But this idea that we can evaluate everything in economics based on whether people are consuming or not consuming, how much they're consuming, and so on. But if you think about it, maybe at the very, very primitive level, consumption, you can pick berries and you can collect nuts. But even that requires some production, i.e. collection, i.e. picking, some action that you have to take. We don't just get our food and our stuff as manna from heaven. It doesn't just appear. The primary act that human beings must engage in is the act of production. Only once we produce can we consume. And indeed, most of our consumption is not just available out there in nature like berries and nuts. Most of our consumption needs to be what? It itself needs to be produced. So I go to work, I produce, and then I take what I've earned from that production. We'll get back to how that all works later. And then I go and buy something from somebody. That's my consumption. But he had to produce it. So there's a sense in which for every act of consumption, there were two acts of production, at least, if not many more, because if you look at the supply chain, there are many more. So what financial markets are doing is matching the producer's need for money and capital to build stuff, to make stuff, with somebody else who has surplus capital, surplus money, and can deploy that money towards that production. So it matches savings and production. Financial markets match savings and production. And by doing so, they provide a return on your savings, right? They allow you to grow those savings. They expand the number of investors, if you will, of savers. There's a way in which labor now becomes capitalist, right? So the labor that is producing, that is creating stuff, if it has that excess, again, is not just hoarded. That excess is now deployed as capital for other investments. And in that sense, everybody becomes a capitalist to the extent that everybody has a 401k, the extent that everyone is saving, everyone is now an investor as well. The saving provide capital to producers. It makes it possible for managers and entrepreneurs to get access to capital that they need in order to expand their businesses or to start businesses. We'll talk about this in a later class, but one of the other things financial markets and institutions allow us to do is control for the inherent risk in the kind of transaction, in production, in our economic activity. It could be the risk of weather going bad. We have financial instruments to protect us from the consequence of bad weather. Here in Florida, you buy what? Hurricane insurance. Farmers can buy options or futures on crops. So there's a variety of ways in which our financial markets allow us to control the consequence of risk. I can't control the weather, right? Markets don't allow us to do that, but they can protect us from the consequence of weather. So again, they facilitate production and consumption. at the end of the day, they facilitate trade and always have facilitated trade. Some of the most, the historical origins of finance are in letters of credit that allowed people to trade across vast geographies without having to lug money around, back and forth. Money, remember, in those days was gold, so it was heavy to lug it around. So you could write a letter of credit saying, yes, he gave me the money, give him the goods. And then they would trade back and forth. Again, we'll talk about this in more detail. Financial markets also provide us with information. And we'll see that particularly when we talk about stock markets. We get real information from financial markets. Information about what people think is important, what is not, what is the future, what is not. Imagine what was happening to the stocks of companies that produced buggies. You know, buggies attached to horses. As Ford is ramping up production of the Model T, what do you think happens to buggy stocks? Well, if you don't know exactly what's going on, if you're not into transportation, if that's not your expertise, just watching the price of the stock of these buggy companies go down gives you information about, something is happening here. Something is changing. I've got some additional information I didn't have before. So financial markets provide us with important information about what is going on in the world, or what is rising and what is falling, what is of interest, what is not, what is dying, what is being born. Think about the fact that AI was something none of us had ever heard of. I vaguely had some idea that there was something called AI, and now like everybody's in AI. And part of that is the hype around AI, but part of it is the fact that a huge amount of capital is now being invested in AI, which is generating huge amount of changes, new innovations, new products that are coming to all of our attention through the fact that markets have made these companies, significant in our lives. Right? We've got that signal, that information. This is important. A lot of people are putting a lot of money into this. Must be important. And we could decide, huge mistake, they're all wrong, they're all stupid, I know better, and that's always possible. But the fact that what's happening, all this investment is going on, is really, really important. And a crucial piece in overall kind of the information that we need in order to assess the future of technology, let's say. So markets provide us with information for businessmen, for entrepreneurs, for capitalists, for speculators, for savers. And again, as we talk about the stock market, we'll talk more about how all these interact and how this really gets laid out and what it means and why this information is so crucial. So if we have to summarize kind of what is going on here, financial market institutions are markets and institutions whose primary function, not only function, primary function, is to allow the efficient conversion of savings into capital in the hands of producers, while allowing us to control for risk. So the transition of savings into capital in the hands of producers used to create, build wealth, while controlling for risk. They encourage saving. They encourage us to save because they offer us a return. So they increase the pool of capital that's available. And of course, that saving are invested in productive activity, which is what drives our economy. Our economy is production. It's not consumption, as Keyes would tell you. It is production. That's what drives an economy. You want to get an economy going, get a bunch of businesses started, right? Get entrepreneurs. Creating businesses is what creates jobs, which what spurs economic growth. So it is production at the heart of it all. And of course, by doing this, there are multiple benefits to the economy. We grow, we increase productivity, and we raise the standard of living for everybody across the board. Indeed, our modern world could not exist without them. We take for granted new innovations constantly arriving. Those innovations are mostly a product of startups, of new companies that are getting money from venture capitalists, right? That are getting money from financial markets. But that's at one level. At another level, you go out to your strip mall and you see these restaurants and little stores. They exist because they're getting bank loans, and they probably had some, not venture capital as we know it, but somebody provided it with capital in order to get it all started. Bank probably was part of that. Everything we have is a product of this. If you don't have the markets and institutions, then everything you raise, you have to raise from your own resources, either money you've saved as an individual in the mattress, I guess, because there are no banks, no stock markets, no place to put them. It's all in your mattress. Or maybe it's from friends and family, which a lot of businesses use that. A lot of businesses starts out with friends and family, but that's it. There's no more. There's nothing beyond that. Now you can only grow based on how much profits you generate. You can plow the profits back into the business and grow the business. But it's only markets, it's only finance that allows you to grow this in any kind of substantial way, right? So you're stuck with doing it all yourself. And if you wanted to grow your savings, if you wanted to invest your money, you would have to go out there and do your own research and figure out who is trustworthy and who is not, what a good risk is and what is not, what a technology is worth investing in and what technology is not worth investing in. You would have to become an expert in every one of these things. I mean, you could go today and buy an index fund that basically invests in the world. And you have exposure to pretty much every major, at least, every tradable business in the world. You can buy a piece of real estate with diversification across the entire United States, potentially even globally. Okay? Imagine if you had to have the expertise to make every single one of those investments. You couldn't, and it would all break down. So the idea of a world without financial institutions and without financial markets as we know them today is really unimaginable. It really is not possible. At the same time, people don't really understand these markets. They don't understand how they function. I mean, very few people understand even how something as simple as a bank works and how it works and why it works and what value it provides. There's been hostility really from the beginning of time, as we'll talk about, towards even the idea of a bank charging me interest on a loan. I mean, most people out there resent that fact, and there's been resentment towards the idea of paying interest to somebody, again, from almost the beginning of time, if not the beginning of time, right? There's this perception the financial markets and institutions are only interested in the short run. You see this all the time. You see it in the press constantly. Stock markets, all companies care about is quarterly, and all the stock market cares about is the quarterly performance. Long term, who cares, right? Which is really interesting, given that we have this amazingly rich, prosperous world with a bunch of companies that, if you really only thought about it in terms of short term, would never exist. Think about a biotech company that doesn't, a startup that doesn't really produce anything that generates income for maybe 10, 15, 20 years, and yet it receives capital. Or think about the fact that we have businesses in this country that if they really only thought about next quarter, how many of them would really exist? Think about the planning that goes into managing a significant business. If you run a small business, or if you're involved in a business, or just involved in life, think about what it means in life to just plan for the next 3 months and ignore the distant future. You wouldn't survive for very long. The fact that we have and live in an economy that is growing, maybe not as fast as we would like, certainly not as fast as I would like, but it's growing, and it's producing, and it's succeeding, and it's innovating, that, in and of itself suggests that there's a lot of thinking going on, and there's a lot of long-term thinking, and yet we're stuck in this mentality of, no, markets are very short-term. We have generally a zero-sum mentality. People do. We generally think that the world is zero-sum. My gain is your loss. If I make a profit, you must have lost. If the bank's making money, then its customers must have lost. In every realm, I think the most illustrative example of this is, I don't know if any of you have ever watched the movie Wall Street. The movie Wall Street is, I believe, a must-watch. It's a brilliantly made movie. It's very much from a particular philosophical perspective. The director of this movie has an ideology. He believes in something, and he's made a movie to portray it. He is an unapologetic Marxist, right? And the movie projects an unapologetically Marxist view of finance. And what does that mean? That means everything is zero-sum. It means that, anybody getting rich is getting rich at people's expense. It means that financiers are exploiters. They're generally bad guys. And they need to be constrained. They need to be controlled. Just some quotes from Wall Street, from the movie. Quote, Wall Streeters get wealthy not by creating anything of value, but by buying and selling at the expense of others. Now, that's a pretty conventional view. They're just paper shufflers. And they're exploiting people. So when we talk about the stock market, we'll talk about whether that's true or not. And because it's not, what is the productive value? What are they creating? What do people in Wall Street actually create? I mean, that's abstract. It's not obvious. So we'll talk about that when we talk about stock markets. Or another quote, the rich get rich not by hard work and intelligence, but by exploiting the poor. I mean, that's a line out of the movie. He's not hiding anything in terms of what he believes, right? And then, there's a number of references to the fact that money corrupts, always corrupts. It's corrupting. Making money is a corrupting activity. And again, very explicit. But, he's a Marxist, the movie director is, but this was an incredibly popular movie. And it reflects, I think, many of the ideas, whether I don't think most people are Marxists, but people have internalized these kind of ideas. And again, these ideas about money, these ideas about wealth creation, these ideas about stock markets and speculating and banking are all deeply ingrained within us. They're all deeply ingrained in our culture. And we'll talk about whether these things are true. So, you can look at movies, TV shows across the board. In Billions, I don't know if you guys have seen Billions. Billions, I think, was a show on Showtime. 6, 7 seasons, very entertaining, worth watching. And in many respects, it's one of the better shows on finance. But the underlying assumption is that the financier, the billionaire at the center of this, cannot be successful, cannot achieve anything unless he cheats, lies, and steals. That even though he's kind of the good guy in the show, there are no real good guys in the show, he's the central focus, he's doing insider trading constantly in illegal ways, even in immoral ways, and clearly is deceiving. And it's presented as, well, how else could you make money? I mean, he actually says, this is how you make money. This is how the markets function. There is no alternative. Again, ingrained in our culture. And there's a consequence to this. There's a consequence to this. And fundamentally, the consequence of this is that because we distrust markets so much, financial markets, because we distrust financiers so much in every aspect of their activities, we therefore have to control and regulate them. Every aspect of the financial markets, of financial institutions, of money. Every aspect of money is controlled and regulated. I mean, where does the money today come from? It doesn't come from the market. It comes from a government institution, from the Federal Reserve, because we don't trust the market with money. We've been, again, told and taught over and over and over again that financial markets, financial institutions, if left alone, not only are corrupt, not only zero-sum, not only don't they produce anything, create anything, even though, again, if you go back to the beginning, everything we touch involves these financial markets and institutions, but somehow they don't create and produce anything, even convenience, it turns out. But they're also responsible for every economic crisis we've ever had, right? Who gets blamed for the Great Depression? It's the money lenders, it's the financiers, it's the Wall Street entrepreneurs. Those are the people blamed. It's speculation in the stock market. That's always the reason why bad stuff happens. Why did we have a financial crisis in 2008? Right? Greedy Wall Street. It's always shocking to me, this idea that in 2007, leading up to the crisis in 2008, greed showed up in Wall Street. They weren't greedy before. They've never been greedy before, right? But suddenly in 2007, greed showed up in Wall Street and caused the 2008 financial crisis. It's greed that made it happen. I mean, Wall Street, if you understand, if greed is, the constant pursuit of profit, the single-minded focus on making money, greed is always on Wall Street. Always has been, always will be. That's their business, making money. Now, whether that's productive or not, different question, but that's the focus. So it can't be that greed suddenly caused the financial crisis, because it's always part of what it means to be on Wall Street. And yet, Wall Street gets blamed, not just for the Great Depression, but the financial crisis. And over and over again, you see this coming. We'll talk about the more recent bank crises, the Silicon Valley Bank and others like that. But I will guarantee, I can guarantee now that the next recession, the next downturn, the next crisis will be blamed on bankers, will be blamed on Wall Street, will be blamed on financiers. It's one of these great kind of mysteries of we rely on an industry, we see how important it is to our lives, we experience it every single day, but partially because we don't conceptualize it, partially because we don't bring it to awareness, we don't know, or we don't appreciate, we don't acknowledge what it's actually doing to our lives. So one of the purposes of this course is to bring it to awareness. Is to bring the contribution to awareness. And then second, there are deep historical reasons, ideological, philosophical, deep historical reasons why we distrust bankers, why we distrust financiers. And again, we'll look at that history. We'll evaluate that history and see where all this hostility bubbles up to. And in doing so, I think we'll gain a better understanding of the actual functioning of these institutions and what finance actually means and how it functions. I give you a quote from President Roosevelt, FDR, who's trying to, again, during the Great Depression, and telling you who this is. And he's very clear, there's unequivocal. And I mean, just the language is kind of interesting because you don't hear presidents talk like this, but that's a separate issue. Here's the quote. He says, "The money changers have fled from their high seats in the temple of our civilization." Right? Think about all the connections there. Money changers, which is, remember what Jesus did to money changers? Threw them out of the temple. Have fled from the high seats of the temple. There's a temple, right? Jesus' temple of our civilization, right? That's where they belong, and that's where they come from. And they were corrupt in the biblical story, and they're corrupt now, and they've fled. In a sense, we've kicked them out of there. we may now restore the temple to the ancient truths. The measure of restoration lies in the extent to which we apply social values more noble than mere monetary profit. Monetary profit, somehow this is bad, somehow this is corrupt, there's something really evil going on here. The rulers of the exchange of mankind's goods have failed. Through their own stubbornness and their own incompetence, have admitted failure and have abdicated. Practices of the unscrupulous money changers stand indicted in the court of public opinion, rejected by the hearts and minds of men. Now, we will talk about, at least somewhat, I mean, we don't have time to really get into it in great detail. We will talk somewhat about the causes of the Great Depression and whether it's the money changes in Wall Street that really caused the Depression, and whether they fled from the temple or whether they were, kicked out, and, whether that is even true, because to what extent is FDR in recovery from the Great Depression, to the extent that we recovered from it, to what extent does FDR really not use financiers, abolish financiers? Is Wall Street dead after 1933 when FDR says this? Or is it just changed? One last on this. Isn't it interesting that almost every single conspiracy theory out there ultimately lands up on a banker, right? Who's pulling the strings of the world? At the end of the day, it's financiers, it's bankers, often Jewish, and we'll get to why Jews later, but often Jews, but bankers, they're the ones pulling the strings. If we're trying to explain what's going wrong in the world, from whatever perspective and whatever the crisis happens to be and whatever's going on, blaming the banker seems to be a safe way to do it. All right, so we've got this juxtaposition of finance being crucial, something we use all the time, hated, despised, distrusted, and as a consequence, heavily, heavily regulated. And the regulations have consequences. The regulations have consequences. All this control stops the market from working the way it would otherwise work. It takes away the thing that makes the market work most effectively. And the market works most effectively when people are pursuing profit. Profit, which we don't like, right? But profit. And the regulations cause, and again, we'll get into details on this, misallocations of capital, which results in misallocations of human resources. Financial institutions spend a huge amount of money and brain power, trying to figure out how to get around regulations. Many of the markets we have today, or have had over the last, let's say, 50 years, are often responses to regulations and ways around them. I mean, the most obvious of that is the money market, which we all, I think, all know about. Many of us might have money in the money market, and money markets were created in order to get around a regulation. We'll talk about which one and how they do that. But a lot of energy, a lot of the kind of complicated derivatives we hear about, they don't have necessarily any economic purpose other than to get around things that the government will not allow bankers to do, and yet they need to get done. Somebody has to do it. So we find ways to get around the constraints that are being put on. And the amount of resources, brain power, doing that rather than doing something productive, if these barriers were not existent, is truly astounding. I think there would be a lot more entrepreneurial activity if not for all these regulations and controls. I think that we'd have a much higher saving rate. We'd have more efficient markets. We'd have fewer booms and busts, fewer crises, fewer crashes, fewer panics. And indeed, horizons in terms of investing would be longer term. We'd think longer in terms of planning. I don't think the markets do it quarterly now, but they certainly could be even more long-term in terms of their thinking. And the consequence of all of that is lower productivity of labor and a lower quality and standard of life that we have. We give up significant economic growth. We give up significant standard of living as individuals because we have decided this needs to be controlled, this needs to be regulated, and we don't trust financiers, and we think they're going to do bad things. All right, let me tell you about the next few classes and what we're going to cover in those classes. Next class, we're going to talk about money. Just focus on money. What is it? And what is its history? And it's not just money, because we're going to also talk about credit and interest rates, because you can't separate money in terms of finance without talking about interest, or another term for interest that has been used for most of human history is usury. We'll talk about the concept of usury, where it comes from, and how it's articulated. The class after that, or an additional class, we'll talk about banking history. We'll talk about banks, how they function. We all use them. We all have checking accounts. We have saving accounts, maybe. Maybe we've even taken a loan from a bank. But how does it actually work? How do they make money? What do they actually do? And again, what's the history here? Do we need them? In what sense? So we'll talk about banking history, how it works, and what its future is. Then we'll talk about the stock market. How does the stock market work? Which I think is, particularly its productive function, is something people really don't understand. And there's a lot of interesting that we can talk about what is in the stock market, how it works, and how it functions. In the context of both banking and stocks, we'll talk a little bit about valuation. How do you value a financial asset? How do you value a stock? How do you value anything, really, a commercial real estate project, or a bond, or a loan, or how do you put a number to it? How do you get a value? What are the principles? I mean, we're not going to get into the details of valuation. That's way beyond what we're trying to do here. But we'll talk about some of the principles around how do we approach valuing any one of these financial assets, financial instruments. We'll talk about risk and how financial markets control risk. We'll talk about how fragile the financial system is, why it seems like every 10 years we have a crisis, and whether that's going to change, and what causes these crises. Also, we'll talk a little bit about bubbles. Are there such things? And if they are, what causes them, and where do they come from? How do you get a financial bubble? And what, in a sense, what do we do about financial bubbles? And in that context, we'll talk a lot about regulation, because regulation plays a big role in cycles, in crises, in panics, in bubbles, in all of these things. We'll talk about regulation, and always in the background is money. Remember, everything finance does is money, and so it's crucial we have a good understanding of what that is. And then we'll end with a discussion of the future. I think the future of banking, or the future of finance, is potentially super exciting, super interesting. We have technologies now that just a few years ago were unimaginable. And it's, I think, really interesting to kind of project into the future and think about what is money in the future, what is financial markets and institutions in the future, how do we raise capital in the future. All of these things are actually in flux, right? All of these things are actually changing. Part of that is because of crypto. A lot of that is fintech and just the ability to transact instantaneously in so many different ways. And of course, that is a potential future, but will we allow it to happen? Do we trust the markets enough to allow them to evolve and to allow it to happen? All right, so we'll end here for this class, and we will pick it up with money and its history next class. Questions?
First of all, thank you for all of this. So we talked about like the human-made, like cultural ways that we kind of like decide we will restrict such thing, we won't do such thing in a capitalist, free market, whatever. In regards to the Near East, they don't have so much banking because usury is not halal in this part of the world. Do you think that this will change, that this is dynamic because a lot of people want in?
So the reality is that in the Muslim world, charging interest, the way you get interest in the bank, and the bank gives you a loan and you pay interest, is against the Quran. Indeed, as we'll talk about next class, it's against the Bible, or it's against certain interpretations of the biblical writing. That's where the Near East gets it from. They get it from the Old Testament. They didn't invent anything here. Usury, which is interest, is against Islamic law. But, and we'll see this a little bit when we talk about the history of money, Christians found lots of ways to get around this, right? There was still a Medici bank. Genoa was this thriving finance center during the late Middle Ages or during the Renaissance, in spite of the fact that usury was a mortal sin. You went to hell for charging interest. So there are a lot of ways to get around this. Indeed, there are banks in the Middle East, and they get around it. They pay you interest. They just don't call it that. They call it something else, and they find different loopholes and different ways in which to restructure this. And I think that's only going to increase. In addition, I think a lot of the Near East institutions are going to use Western financial institutions. They already do. Because in the West, we're allowed, and they'll let us in. So I don't think that'll be a barrier. In addition, there's no prohibition in Islam against stock markets or against trading in stocks, because that's profit. The prohibition is not about profit. The prohibition is just about interest. We'll talk about the difference between those two, but it's just about interest. So in the Muslim world, they can still, have public companies. The Saudi oil company is publicly traded. It's a majority owned by the monarchy, but it is publicly traded out there. So put it this way: I don't think that the attitude towards finance in the Arab world or in the Middle East is what is going to constrain them. I mean, there are lots of other things that I think will constrain them, primarily culture, lack of individualism, authoritarianism. These are all sheiks and kings, and there's not exactly individual liberty, even in a place like Dubai or in Saudi Arabia or any of these places. So that is the constraint on them. The constraint on them is not finance. The constraint, I think, on the Near East today is culture. Saudi Arabia wants to have an innovation center. They want to have, high tech. You're not going to get high tech unless you allow some freedom. And are they willing to allow freedom? Are they willing to allow people to think outside the box? Are they willing to allow companies to rise and fail? Are they willing to lose money? We'll talk about the fact that failure is really, really important for making money. Because some companies have to fail when the buggy industry has to fail, and that capital gets reallocated to places like the automobile industry, which is rising. So are they going to allow kind of what Shumteta called creative destruction, and the dynamism of marketplaces and the dynamism of individual entrepreneurs? That I don't know. That is the challenge that they face. I don't think the challenge they face is necessarily the Middle Ages attitude towards money. That I think they will ultimately overcome.
Hey, Yaron, I'm excited to be here. I'm a big fan of your show. I suggest anybody who hasn't seen it, who's watching this, go to the Yaron Brook Show on YouTube.com. Anyway, I was just in New York. I flew in, and while I was going through JFK, I noticed they're putting a new $19 billion investment. I presume this is going to be Port Authority or whatever agency manages JFK. I guess my question is, why is it that financial markets have to match savings with productive activities rather than the government matching taxes, let's say, with investment?
Well, the government is supposed to match taxes with investment. I mean, in this case, the way they're going to fund the expansion of JFK, the way government usually funds infrastructure, is they issue bonds. They issue bonds to bondholders, and you'll buy the bond. That'll provide them with money. They will promise you a certain interest rate return on that bond. So you will collect your coupons, you will collect your interest payments on the bond. And then in order to pay you those interest payments, they will take tax money and use it in order to pay you back. Ultimately, they'll pay you the principal. All of that supposedly is coming from tax money, and that is how government presents itself as funding projects, whether it's local or federal. Now, on a local level, to a large extent, they're going to have to match expenditures with taxes. Why? Because on a local level, they cannot print money. They cannot print money. So the New York Authority cannot print money. So the only way it can pay you back the bond is through taxes. The real problem you get with government is when you get to the federal level, where they can't print money, and now they can avoid taxes, raising your taxes in order to provide all the spending that they do. They don't raise taxes, and instead they keep refinancing. So how do I pay back your loan? By taking a loan from him. And then how do I pay you back? I mean, it's a kind of a pyramid scheme. It's a Ponzi scheme. But it's a Ponzi scheme with a printing press in the background, where they can always, if they want, just print more money in order to pay everybody back. Again, they don't admit that, but it's obvious. And they don't say that. And the markets think of it this way. The markets think, look, the government has to pay this money back. It will pay this money back. We're assuming they're not going to default on it. So there are only two ways it can pay it back. It can either raise taxes, or one day, when they decide to pay it back, right, because our debt is only increasing, or they can inflate it. They can print the money. And part of what financial markets are doing constantly is trying to figure out how the government's going to handle all this debt. One of the reasons we actually get inflation, I think we have inflation right now, is because the markets are looking at the government's debt go like this and going, there's no way they can pay this back through taxes. They don't have the balls to raise everybody's taxes to pay this back. We would probably rebel against that anyway. So the only way they're going to do that is by inflating in the future. And if they're going to inflate in the future, I might as well raise prices right now. Might as well anticipate that inflation and drive prices up right now. So, in that sense, the federal government doesn't have to match taxes. They can inflate. Now, you could argue inflation is a tax. It certainly lowers our standard of living. It lowers our purchasing power. It lowers our quality of life. But nobody thinks of it as a tax. But that is the reality. But the federal government can do both those things. The local governments can only raise taxes in order to pay for it. So we're going to get a beautiful JFK. It looks gorgeous, the renovations that they're doing there. And taxes in New York, or maybe the airlines pay it, which means you pay it through higher tickets. One way or the other, we all are going to pay for that. But at least in this case, we will get a nicer airport. Now, there are lots of other government spendings where you're not even going to get something concrete that you can appreciate. And of course, you could argue that if the airport was private, maybe its funding would be even more effective and more efficient. Maybe it would be even more beautiful. But that's not the world in which we live.